Welcome to Online Trading Campus and welcome to our unique OTC Futures course. Let's continue with our Module 4, Advanced. In Lesson 2, we will cover a strategy add-on for daily income traders, which is called Opening Hours Trader. In this lesson, you'll learn how to use the Opening Hours trading strategy. We'll talk about the strategy add-on, and then we'll talk about some real specific trading examples and some rules that we need when using this trading strategy add-on. Let's go ahead and jump right into this. What is the Opening Hours trading strategy? The name implies two things. Number one, this is a strategy add-on only for daily income traders. And number two, as a daily income trader, you want to focus on the opening hours. But what opening hours? There are many different futures markets, hence different opening hours. What you want to do is focus on trading during a very specific 3-hour, let's call it a 3-hour window of opportunity. And the strategy add-on is only applicable for the US equity indices. Let's walk through the logic here. At around the open of trading of the US equity market, because remember, we have specific trading sessions and the highest volatility right around 8 a.m. up until 11 a.m. Standard Eastern Time, when the European session overlaps with the US session. That's the real window of opportunity for the equity indices that you're looking for as a daily income trader. It's near the open or close to the open, but it's also a little before or a little after most of those opening prices as well. Now, why the open? Why near or at the opening prices? Well, think about this for a moment. During the opening of most of these major markets out there, there's a tremendous amount of order flow coming in and out of a particular market. This is where supply and demand are most out of balance. You could have a tremendous amount of supply or tremendous amount of demand, but one way or the other, you can see this really big skew of imbalance. And this is good. This is what you want as a daily income trader. Because as daily income traders, you want several things. Number one, you want liquidity. And by trading 8 a.m. to 11 a.m. in the US equity index market, that's going to give you really good liquidity. You also want good profit potential. Think about this for a moment. In order for you as a daily income trader to get good profit potential, how do you get that? Where do you find that? Well, one way that you find this is when the markets are most actively traded, not just volume-wise, but also most actively as far as the range of price movement from high to low. And that's going to be right in that 8 a.m. to 11 a.m. Standard Eastern Time window of opportunity. For example, what if you're trading the S&P 500? Well, the S&P 500, the equity market itself, doesn't open until 9:30 a.m. Standard Eastern Time. But that's the equity side. The futures market is open almost 24 hours a day, so it's open pretty much around the clock. Technically, it's not opening at 9:30 a.m. It's just very, very active at 9:30 a.m. But there's also a lot of activity before that and after the open, of course, as well. At starting around 8 a.m., we are going to start to see some volume pick up, some price movement increase as well, and this is good. This is what you want to see. Same thing with other equity markets, like the Nasdaq, the Dow Jones, the Russell. Why else do we want this? Well, let's dig deeper into the logic. We want to find trades that have low risk, high reward, and high probability. Where do we find that? Where do we find all three of those factors, low risk, high reward, high probability, all at the same time? Well, you guessed it right. Right about the 8 a.m. to 11 a.m. window of opportunity. Now, this doesn't mean that you're not going to find those trades at other times of the day. Of course, you certainly can. I'm certainly not saying that. But what I'm saying is you want to focus at least the majority of your daily income trades as intraday short-term traders between 8 a.m. and 11 a.m. so that you can get more frequency of low risk, high reward and high probability opportunities where you can get good, healthy price movement, which increases our profit potential and of course excellent liquidity. Alright, let's dig a little deeper here now that we have the logic squared away. Let's get into this strategy. What is it that we really want to start to do here? Well, it is quite simple. We want to focus on two things. Number one, our lower time frame demand or supply zone has to be located in that 8 a.m. to 11 a.m. window of opportunity. And number two, we also want to get into a trade, long or short, right in that 8 a.m. to 11 a.m. window of opportunity. Okay, but first things first. Let's get our chart settings correct. To do that, you need to go to Format Symbol, right mouse click on the chart like you see on the screenshot, and make sure your display time zone is always on exchange and not local. Now you can use two vertical lines and narrow down our window of opportunity like you see here on the chart of the S&P 500. In terms of our supply and demand strategy, basically what we are going to do here is exactly the same thing, but only for daily income trading. We apply our rule-based strategy, our three-step process, location, direction, zoning process, our trade management rules for entry, stop and targets. But we just add one additional layer. We just want to focus on that time between 8 a.m. and 11 a.m. Standard Eastern Time when trading the equity indices. This is when we have a lot of these short-term market moves that are most predictable. Remember, we are looking for not just liquidity, volume to get in and out of the trade when we want to, but also some good healthy price movement, and we find that in that 8 a.m. to 11 a.m. window of opportunity. Now let's walk through an example of the S&P 500. Let's take a deeper and closer look here on that chart. This could apply to any of the US indices, but this is the S&P 500 in this example here. Starting at 8 a.m. Standard Eastern Time, right there, this is where you really want to start the game, metaphorically speaking. This is when the game starts, whistle blows, we are ready to start trading for daily income. Now, we are actively looking to match up our rule-based strategy of supply and demand as soon as that game starts at 8 a.m. Standard Eastern Time. Once that whistle blows, mentally for us anyway, we really want to start looking for buying or shorting opportunities. Again, good liquidity and excellent price movement, good range of price movement, and on top that gives us extra profit potential. We can start at 8 a.m. and go all the way to 11 a.m. That's really the window of opportunity that we are looking to get into a trade. But not only that, our high quality lower time frame zone has to be also located in that specific time window from 8 to 11 a.m. Now, let's walk through an example. Let's say that we found a good buy setup in a demand zone right here yesterday in our window of opportunity, and we are about to take the trade once price comes back into our demand zone. Alright, now take a look at this first movement down that you see right here. This is a strong move down, a nice drop in price. Now notice, here's the other reason why we want to focus between this 8 and 11 a.m. window of opportunity. You get good price movement. This is typically when you are going to see the largest moves for the day. Now, that's most days out there. Of course, there are exceptions. But for most of the time, your biggest moves are going to happen somewhere in that 8 a.m. to 11 a.m. time window of opportunity. We can see here a large move down, and then it quickly reverses from our demand zone, and we have a large move up. But look what happens after 11 a.m. It starts to drift down lower and then up, but notice the range from high to low that price moves is less. Each candlestick that you see becomes a little bit smaller and smaller as time goes by. This is actually quite common for most of the US equity indices. They have times where they are more actively traded, and not just volume wise but price movement wise as well. And that's why I really want you to focus the majority of your daily income trades from 8 a.m. to 11 a.m. for the US equity indices. But of course, we could find some good trading opportunities after 11 a.m. But it may take longer to hit your target, and you may have to expect some smaller moves. That's from the lower volatility and less volume. Alright, let's take a look at some other examples here. Here's a Nasdaq chart. We identified a small drop base rally off the chart to the left. Price goes up and then it comes back down the next day. But when it comes back down, it touches into that demand zone, penetrates the demand zone just a little bit there, right about 10:45 a.m. And then it has a very strong move out of it shortly after that. When we see this strong move out of there, we know, hey, that demand zone definitely worked. And if someone took that trade, certainly quite a bit of profit potential for them. Again, we want to identify demand zones that fit our supply and demand strategy. In this particular case, we want to have the entries of our orders taken right between that 8 a.m. and 11 a.m. window of opportunity. But we notice it's 10:45 a.m. So what do? Well, that's okay. We are still in that window of opportunity. Now we are towards the latter end of the window of opportunity, but we are still in it. So that's okay. Rules are rules. So we can still go ahead and take that trade. Again, we can take trades even after 11 a.m. That's certainly going to be possible, and we are certainly going to find trades like that. But we definitely want to focus the majority of our daily income trades in that window of opportunity. That's when we are going to find the best bang for the buck out there. Alright, let's look at some other example here. This is the Russell, a supply zone off to the left. And again, we would plan all that out ahead of time. But when price goes up into that supply zone, that would trigger our entry. But look at when it happened, the time from 8 a.m. to 11 a.m. All at the same day. Supply zone and entry at the same day. Again, that's that window of opportunity that we are looking for. And of course, we can have the zone triggered at the same day as well. Nothing wrong with that. In this particular case, we have a drop-based drop supply zone that we see there. Price rallies right back into that supply zone right about 9:30 a.m. and that would trigger our shorting opportunity. We could take a trade and we had a nice move on that trade right there. This is exactly the type of scenario that we are looking for, where we have a supply zone that formed about 9 or 9:15 a.m. Price has a strong move down that signifies that we have some good supply there. Price rallies back up. You can see the wicks going up into that supply zone there. That would obviously be the point where we would short, and then you had a nice fall through to the downside. This is a nice daily income trade and it happened right in that window of opportunity, exactly what we want to see here. But again, notice the theme here. Good price movement from 8 a.m. to 11 a.m. on pretty much every one of these charts that you have seen here. We have seen some good, healthy price movement. And these aren't just the ones that I've selected here for you. You go back, backtest it, and look at any US index chart that you want out there. And most days you're going to see good profit potential during that time window of opportunity on just about all of these US indices that you would be trading. Another one, Dow Jones, another supply zone. Again, we would plan that out ahead of time. This one happens to be a rally-based drop that formed right about 11:15 a.m. You see, this supply zone was formed a little bit after 11 a.m. So according to our rules, we would need to dismiss it. However, now, if you see that most part of your zone, leg in and base, was created inside our time window of opportunity and only the leg out started to form at 11 a.m. and was completed only 15 minutes after your time window of opportunity, of course we would still use that zone. So the zone by itself is still according to our rules. But then when price pulled back, actually it came back in twice, hit the zone first around 1:30 p.m. It went down a little bit and came right back up around 2:30 p.m. And then you got the really nice drop through to the downside after that. Again, the key here is always identify your demand zones or supply zones that is located right around 8 a.m. to 11 a.m. and wait for price to retrace into your high quality lower time frame zones. Now in that example, price came back into our supply zone at a time when our time window of opportunity was already over. But you see how this trade worked out beautifully. And now you have to decide if everything else lines up with your overall strategy and rules, and the only variable that is not as per your rules, which is the time of the arrival of price, we could still take that as a short trade. And you can see what happened after. It was a very strong drop. My point here is basically for the time of arrival of price, you could either be stricter and keep that 8 a.m. to 11 a.m. rule or dismiss it. For the time of arrival of price rule, there is no right or wrong. What is important though is that you decide to use one rule consistently, backtest it and test it forward for a couple of trades and see what works best for you, and then continue to apply whatever arrival rule you opt for. So that's the power of this 3-hour window of opportunity. In summary, make sure when you're intraday trading, focus the majority of your equity index trading or all of your equity index trading in that 3-hour window. You'll see not only good liquidity, but also some really good price movement. So let's summarize your rules for the opening hours trader strategy add-on. Your lower time frame supply or demand zone has to be in the 8 a.m. to 11 a.m. time window. And price has to arrive in your lower time frame supply or demand zone in the 8 a.m. to 11 a.m. time window. You can also backtest the alternative arrival rule that price does not have to arrive in your lower time frame supply or demand zone in the 8 a.m. to 11 a.m. time window. However, your lower time frame supply or demand zone always has to be in the 8 a.m. to 11 a.m. time window. There's no right and wrong. In that case, it's what works best for you. Again, keep in mind that your 3-step process, location, direction, lower time frame zoning process, always remains the same. The best trades always meet 2 rules: your big brother small brother principle, and you trade with the trend. The strategy add-on is only applicable for daily income and equity indices. For your lower time frame, you can go as low as 15 minutes as a refining time frame. As a general rule of thumb, my recommendation to you: only practice daily income once you become really good at weekly and monthly income, not the other way around. Yes, rules are the same, the strategy is the same. However, the volatility is much higher intraday and you need to be able to act much faster. Bottom line, in daily income, you don't have a lot of room for mistakes. That's it for this lesson. In lesson 3, I will teach you another strategy add-on called Globex Breakout Bait. So stay tuned for the next lesson.